Let's look at the main areas of compliance with the GIPS standards. The first area is compliance fundamentals. I talked earlier about defining a firm, that again you must have a clearly defined firm. The reason for this is that having a clearly defined firm defines the firm's assets. Firm total assets are the market value of all assets under management within the firm. Changing the firm's organization might not result in changing the historical composite results. Firms are encouraged to define themselves very broadly. For example, all geographical offices operating within the same brand name. The second area under compliance fundamentals is that the firm needs to make sure that it's keeping current. These standards are going to change over time. In order to continue to claim compliance, you not only have to keep up with current happenings in the GIPS standards, but know what is changing and make sure you comply as things are changing. You need to document all of your policies in writing. You also need to use compliance claims properly. After the regulations are met, the firm can state, this firm has prepared and presented this report in compliance with the Global Investment Performance Standards. And again, a firm claiming compliance must comply with all of the standards. The firm also has to provide composite lists and descriptions to prospective clients and compliant presentations on request. Another very important part is verification by a third party. It's not enough to say that you are in compliance and to say that you've got internal controls, but you also have to have a third-party verification. Verification is a review of the firm's performance measurement by an independent third-party verifier. Verification has to be conducted for the entire firm, not just a single composite, and a verification of some sort is encouraged and should state something along the lines, the firm has been verified for these periods and list the dates. A copy of the verification report is available on request. So very specifically, state that it has been verified and details are available. The second area concerning compliance refers to data requirements. The data must be consistent. It needs to provide a basis for complete and accurate and comparable investment performance. You need to have thorough data, very accurate data, so you are able to compare portfolios from country to country. Also, it is very important to use market values, not to use book values or not to use a cost basis. What is the portfolio worth right now? What is its market value? Another point is to be sure to value the portfolios at least monthly. That's the standard right now. Pretty soon that standard is going to change and require that you value every time there's an external cash flow, every time you have a new cash flow coming into that portfolio. Also, very important to use trade date accounting to show when you actually made the trades and account for any cash flow changes that way. Use beginning and ending dates that are calendar year dates unless the composite has a non-calendar fiscal year. The next area that's addressed in the standards is calculations. Very importantly, the calculations have to be done in a uniform way using uniform methods. One of the rules is that they need to use total returns. This includes any income from any investments, any realized or unrealized capital gains. The next rule is that you want time-weighted returns. What that means is that sometimes you're getting cash flows throughout the time period that you're measuring. You need to weight those so you don't have a really super return because you added a lot of cash flow. That returns reflect the actual return that the investment has made, not additional cash because more cash was put into the portfolio. Another rule is that the calculations must be asset weighted, not equal weighted. In other words, what that means is if you have a small asset that has done super well and a larger asset that maybe hasn't done as well, you have to put more weight to the larger asset that has not done as well. Another rule is that returns from cash and cash equivalents in a portfolio must be included as part of total return. In addition, you need to calculate portfolio return by using actual trading expenses, not estimated trading expenses. Now, this potentially is a problem if the expenses are part of bundled fees. In other words, it's hard to tell exactly what the actual expenses are. Then you've got to do some extra calculations to make sure you're being accurate. Bundled fees are things that include all-in fees where asset management, brokerage, and custody are handled by the same company, or they could be wrap fees where fees are based on investment advisory services as well as transactions fees. So the idea here is you're trying to separate out what are the actual transactions fees, and you're subtracting that from the portfolio's return. If there's no way that you can unbundle these fees, if you just can't do it, then you need to include all of the bundled fees. In addition, composite returns have to be calculated by asset weighting individual portfolio returns at least quarterly. By 2010, that's got to be monthly. I'd like to talk a little bit more about the rules relating to composing composites, because again, the composites are at the heart of the GIPS standards. I've mentioned before that you've got to use all fee-paying discretionary portfolios, no non-discretionary portfolios, and that again a composite is a grouping of portfolios with similar investment objectives or strategies. Composite returns are asset-weighted averages of all, and I stress all, the portfolios in that composite. You can't pick and choose. You have to use all the portfolios that are in the composite. Another very important rule concerns keeping terminated portfolios in that composite. You also can't pick and choose by saying, this client was unhappy, they left the firm, so we'll exclude that client's portfolio from the composite. Usually, if the client has left the firm, it's because they're unhappy about something, return wasn't as good. So you can't pick and choose. That's called survivorship bias, when you have only those who desire to stay with the firm and with the portfolio. Another rule is that you can't switch portfolios among composites. In other words, you can't take a portfolio and say, today it's in this composite, tomorrow it's in a different composite. You have to be consistent. The only valid reason for switching is if the client guidelines change. Say you've got a client with a growth portfolio and that client says, no, I want to be more conservative, give me more of an income portfolio. Then, of course, you'd have to switch that client's portfolio to a different composite that had that new goal. If you do that, you have to include the past history of a switched portfolio in the appropriate composite. You also need to make sure you treat convertible and hybrid securities consistently over time and within composites. Another rule is that you can't create a standalone composite by using carve-out returns that don't include cash. And let me explain what that means for a minute. If you take a single asset class from a multiple asset class portfolio, that's a carve-out. You can't carve out a single asset class without making sure that you allocate the cash to the separated returns. In other words, you've got a multiple asset portfolio, you carve out a single asset class. There may be some cash associated with that portfolio. You need to make sure that the cash is allocated appropriately, that some of it stays with the portfolios that are left, some of it stays with the carved out portfolio, and that you've got a reasonable method of determining what cash stays with the original portfolio and what cash goes to the new composite.